Good afternoon. My name is George Lee, and I'm the founder of Hydrus.ai. For this interview, I have Russ Wermers, who is the chair of the Department of Finance at the University of Maryland. In this interview, we're going to be discussing a variety of topics from ESG to its intersection with finance, and to be able to understand a better viewpoint in terms of academia for ESG and the future of corporate social responsibility, governance, and other topics. For each question, I will go over the prompt, and then I will pass it over to Professor Wermers, who will deliver an answer.
Hi, George. Hi, George. It's a pleasure to appear on this recording.
Thanks, Professor. Can you start out by telling us a little bit about your background and what you do?
Yeah, George, for about the last 30 years, I've been conducting research on investing, and that includes looking at the investment performance of managed funds, actively managed funds, and also passively managed funds. That is, I think, what I'm known for. I have a textbook on this subject. I've written many scholarly papers on this, and so I specialize basically in the strategies and the strategies used by managed funds and the resulting performance of those managed funds.
Amazing. For our next question, I'm going to dive a little bit deeper into your experience. And so for this, so you've got almost 3 decades of experience doing this. Where do you see the financial industry going in the next 5 years?
So let me ask you, in which dimension are you interested in talking about? Are you interested in talking about ESG investing?
So that will be a future question, but for this, okay, it's more of like thinking about, the financial industry. Specifically, there's been a huge shift to quantitative finance over the past decade. And so we're really wondering, like, where do you see that going? Because there's a lot of transformations in the financial industry. And so, a lot of banks have had to take things remote, due to COVID-19. And so where do you see things going there?
Sure. I think that the financial industry is obviously going more online rather than in person. It's more use of things like robo-advising for investment advisors. It's more use of technology, electronic trading instead of human intervention. So beyond the technology aspects of where the industry is going, I also see that the financial industry is likely to be more concentrated with big players than it has been in the past. And I explain this to a large degree in a paper that I've written recently that will be published in the Journal of Investment Management. Short answer to why concentration will increase is that the big players will have some big advantages in this developing technology by leveraging it better than smaller players. Trading costs will continue to go down. I think the individual investor will generally benefit from this. Active management will become cheaper because of the lower costs of being an active manager. And I think in general, there will be more and more types of securities and security types, such as ETFs that cover different parts of the market, sectors, styles, strategies than there have been in the past. So there's going to be there's going to be a huge explosion of available securities in the next 5 years, as well as a real change in the way that asset management, trading, and things like this are going to be conducted. Mainly, I think, or partly, I think, impacted by the explosion of technology, but also perhaps we'll see more happening because of the COVID-related disruption here. This may cause more of a desire for consumers and even professionals to do things online than in person.
That makes a lot of sense. I think we, see this going on over the past few months. Specifically, we see a lot of these ESG related ETFs that have been sprouting up, that have had a lot of inflow. CNBC and a variety of other media outlets such as Bloomberg have also commented and published a lot of articles and information regarding these funds. For the next few questions, we're going to dive into ESG specifically and some of the insights and experiences that you have been able to collect over the experiential learning program this past summer at the University of Maryland. So environmental, social, and governance was really an unfamiliar topic to you until the creation of this experiential learning program. Correct me if I'm wrong, with Hydrus. What have you found most interesting in your research so far of this topic?
Yeah, I'm not sure it was unfamiliar, but it was certainly less familiar. I knew what ESG investing was. I knew a few of the studies of ESG, but thanks to Hydrus and the experiential learning program, which involved 8 of my students, 8 really smart students working with Hydrus. I learned a lot more myself about the potential pluses and minuses of ESG investing. And I think that what I have found most interesting in my research or in my learning through this summer team experience, advising the team for Hydrus, is I think that ESG, number one, ESG investing is becoming exponentially important. Many investors are pushing their money, including pension funds, mutual fund investors, and a lot of other investors are really, they really desire to have investments in the ESG space. So it's causing an explosion in ESG investing, in ESG funds. And I think in turn for companies that corporations stock, where the corporation is following good ESG practices. I think that's the most interesting thing. And I think if there's a maybe second most interesting thing in my studies so far of ESG research, and George, during this summer, where I advised the team, we went over several top scholarly papers. I think what I found interesting or maybe surprising in that research is that there is a role for ESG beyond just providing a better risk reward profile absent of ESG. And what I mean by that is for certain investors who value ESG friendly companies, these investors can find that the investments in ESG funds and securities give them an optimal experience in their investment portfolios, and because of their ESG values. But even beyond these non-pecuniary benefits, I think that there is research that shows that investing in stocks or funds that take account or pay attention to ESG factors is a good hedge against surprises in things like climate change happening at a faster rate than we think it will now. So I think I've really expanded my horizons from just a simple person who thinks about simple Markowitz theory mean variance analysis to thinking more deeply about what is going on with ESG, how it helps to hedge your portfolio, and I think concepts like that.
Amazing. And so going on from that, we've talked about ESG and its relationship to diversification, to being able to hedge against a variety of risks. Do you believe that, as you've mentioned, there's a lot of academic literature. Do you believe that these factors may be correlated to driving equity returns?
That's a great question. I think what I've seen is that, and I saw an academic paper, I think a couple academic papers presented at the University of Maryland, I guess remotely, by outside academics, that indicates that ESG factors are priced in the marketplace, that investing in high quality, I guess high attention, or high corporations that pay high attention to ESG factors, and specifically climate change, may be priced higher, may have experienced higher past returns because of the demand for those types of stocks. So in essence, I think that yes, the exposure of a particular stock to ESG risk, and I guess I would say that means things like coal mining companies or things like that, probably has, I've seen evidence that those types of ESG high risk stocks probably are driving higher equity returns, but only perhaps only because they have higher levels of risk to the unknown future systematic risks of climate change disruption being worse than we expect today.
That's a very interesting viewpoint. And so for our following question, this really goes a little bit deeper into the ESG factors. Beyond climate change and the issues that we face on the environmental side, what other factors do you believe, what other driving factors do you think are making ESG more relevant in the modern day?
Well, I think definitely I'm the director of the Center for Financial Policy, and we've had a series of webinars on the level of I guess the social aspect of ESG, which is the level of diversity in asset management companies, meaning, that I think the webinars that we've had with some top people in investment management, as well as in some discussions that I've had with as in my role on the SEC's Asset Management Advisory Committee. This is a committee that advises, an outside committee that advises the Division of Investment Management at the SEC. One of the main factor that we found in both my webinars for my center and in my role as a member of the AMAC committee for the SEC is that ESG social factors have been by and large underappreciated in asset management companies. So this means that the asset management companies are not looking for diversity in a way that might be most appropriate and optimal for outcomes. And I think that to some extent this translates into, I think, these asset managers looking more at companies that have diversity in their employment and issues like that. So I think that the social is also a very important part of ESG. Governance has always been environmental is climate change, to a large extent. Social, an example I just gave, diversity. Governance has always been a major driving point of financial economics scholarly research. Generally, governance issues have been limited to what is the best governance structure for a corporation to enhance or to maximize shareholder returns. And I think that there is a lot more, I think there's a lot more research now that says that this is not quite so easy as to just think about shareholder returns, because governance can also be a factor in improving long-run stock returns, firm returns, profitability relative to short-run returns, stock profitability, corporate profitability. So these, I think, are things that are making ESG more relevant. So let me summarize, George. I think it's a bit of long-term versus short-term. If you think long-term, ESG makes a difference. If you think short-term, ESG may be, I guess, underappreciated. And so I think that is those are the things that are making ESG more relevant, is the push by pensions, sovereign wealth funds, and many others for achieving long-term profitability and stock return goals. And I think ESG is lined up with those types of goals.
Absolutely. I think some of the research that we had done this summer, specifically looking into some of the academic theory papers, very well made a point that a lot of these investments are underappreciated until they are appreciated, and I think COVID-19 has definitely demonstrated that as well. So for the next topic, so out of these three factors, the E, S, and G factors, which ones do you really, or like which specific one, I guess, we can focus on, do you find the most interesting from a research perspective going forward?
Yeah, so I'm not a corporate finance researcher. I'm a financial markets researcher. The governance factors, I think, are more interesting for corporate finance researchers. The one that I'm super interested in right now, and one that I am helping to build a cross University of Maryland campus research initiative is climate change, which is the E of ESG. So we are at the University of Maryland building a interdisciplinary research program between our Department of Atmospheric Sciences at the University of Maryland, one of the finest in the world, and our finance department, which I think is also one of the finest in the world, to investigate the effect of climate change on financial markets, financial risk, the risk of real estate investments, and so on. I think that is, for me, the most interesting and the one that maybe I can contribute the most to society at this point in my career.
That makes a lot of sense, and I'm very excited to see what the partnership will yield in terms of research, in terms of environmental research going forward. On the contrary, there's a lot of information out there. We have gone through a variety of data sets. Some of the data sets in ESG that don't have the most accurate information, or the most like relevant information. So really, what are your fundamental doubts? Do you have any fundamental doubts about ESG and some of the methodologies that are currently in existence?
Yeah, George, very much so. I mean, I think that the ESG measurement methodologies are very crude at the moment. I don't want to cast aspersion on those corporations and companies that are trying to measure ESG, because they're providing a service. But the measurement of ESG exposure or efforts by a corporation or by an asset manager very much are based on things like surveys, things like looking at very general things, and not about measuring very detailed data points about a particular corporation's ESG exposure, risk exposure, and efforts. So I think we've got a long ways to go. I think it's a new field. It's a field, as I said, that ESG investing is a field that is becoming explosive in terms of interest by investors. And I think we've got a long way to go, which will be driven, I think, by this increased interest. We have a long ways to go in terms of developing appropriate and accurate measurements of ESG and methodologies to incorporate those measurements into an ESG score for a company or for an asset management firm.
What I'm curious to follow up to this. What period of time do you think it would take to be able to, develop a more modern standard where, where there'd be a sort of a more scientific degree of accuracy, if you will?
Well, we're kind of trying to think about this in my role on the SEC's Asset Management Advisory Committee. How fast will this happen? I think it depends on data availability. It depends on the cooperation of corporations in seeking to in sharing their data, their measurements about the things they do, the amount of carbon pollution they create, the their exact procedures for hiring employees with diversity, things like this. Yeah, I don't know if there's a time frame for this, but I think there's going to be, George, I think there's going to be an explosion over the next 3 to 5 years in data and methodologies that occur in the ESG space. And I think there cannot help but be a change in this, given the trillions of dollars that are being allocated to this part of the market.
One of the things that you had always mentioned in the past was the whole notion of being more of a natural skeptic. And I think the very valuable part of that is we're able to, we're able to find out certain truths that may exist that you otherwise would overlook, that the average, that the herd, so to speak, right? Like the common, sort of like the wisdom of the crowd would overlook. What events in the past have caused you to really describe yourself as that?
Well, George, I've always believed in climate change research since the 1980s. I've never been a skeptic about the research. I do believe the climate is changing. I do believe it's caused by chiefly by human, I guess, events in the Industrial Revolution and our activities, our economic activities. But I think in the past, I was trained, to be honest with you, in the kind of the Chicago School of Economics, which is that anytime that you think about things that are non-pecuniary in terms of choosing stocks or other securities, you're going to pay a price for that. You're going to either get higher risk or lower expected returns. And I think that, I think I've come to be convinced that I wasn't thinking deeply enough about this. And as I said, I guess I mentioned several minutes ago, the value of ESG responsive companies and funds, I think it should not be underappreciated, because they really do have a huge value for hedging against future unexpected climate change events, which I think are only going to occur more and more frequently. If in the best world, in a Panglossian world, maybe climate change will end up being less less impactful than we think. But there's always the risk that climate change will become more impactful than we think today, and that the change in climate will occur faster than we have forecasted today. And I think that there are just a lot of forces in the market, including the I guess the natural tendency for people to be slow to change their beliefs, I think means that those who are thinking ahead and thinking about what could happen will probably benefit from thinking about ESG investing. Um, in other words, probably the average investor has underappreciated climate change. So I think this could pay some nice dividends for those who actually look at the scientific evidence and take a look at this with as unbiased view as they possibly can.
Some of these green ESG funds, though, they do hold, certain securities that are not considered really sustainable. For instance, there's a very large consumer consumer packaged goods company that has been involved in various litigation because of its baby powder being linked to cause cancer. What do you think is the reason that some of these securities have been included in these modern day like ETFs that really focus on green and sustainability?
Yeah, I think it's basically greenwashing by the company and greenwashing by the asset manager or the as you put it, the ETF. The ETF is looking for easy scores on picking ESG stocks that that they think may produce. They're probably these asset management firms or the ETFs that are picking kind of these greenwashed or not truly ESG dedicated securities in their portfolio, or perhaps partly driven by the desire for them to find ESG securities to meet this huge demand for them, and may also partly be driven by a desire to produce short-run profitability and returns instead of the long-run profitability and returns that I mentioned earlier are more, I think, characteristic of well-performing or ESG, high ESG types of stocks.
I think that gives a lot of investors, from retail to institutional, a lot to think about when they're choosing securities for their portfolios. For our final question, I know you mentioned you don't study governance, like corporate governance, but one of the things that we recognize is that governance is really like the crux of whether or not we make decisions when it comes to environmental or social, or other factors that impact an organization. So given the fact that, a lot of corporate strategy, a lot of, like decision-making hasn't been very much data-driven in the past, do you really think that, do you believe it'll be purely more data-driven, where we're just gonna have a lot more information, a lot more centralized information with sort of like a single source of truth, if you will, where you have, singular metrics that you can really look at, various governance factors by? Or do you think there are going to be other factors? For instance, I think regulation is one of those that we're going to have, come into play for, a few industries. So what do you think the future of, really decision making at that level is going to be driven by?
Well, I think the SEC is going to be, and other government agencies are going to be more and more keen to provide, I think, I guess not rules, but I guess guidelines for good governance. Things like, making sure that the corporations are more transparent and provide better data on their ESG efforts. I think the SEC has a ways to go on that, and I think the SEC realizes this, and this is why ESG investing is a major, I guess, a major topic in the committee that I'm a part of at the SEC, the AMAC committee. And I think that outside of regulation, you asked for that too, I think, you know, the speed of information and the amount of information that is created about firms through, you know, text mining, their filings. I'm doing a project right now that looks at text mining their earnings conference calls. All of this stuff is only going to increase over time as technology improves. And I think that the outside monitors of this, including academics, places like Morningstar, but also, you know, the smart hedge funds, the smart mutual fund companies, in mining data, whether it be Twitter data, whether it be 10Ks, whether it be speeches by executives, or other metrics, or maybe by looking at satellite measurements of certain things, will, I think, hugely affect the future of governance of corporations. Data-driven, absolutely, but also I think transparently driven as well, by the regulatory authorities and also by investors who are demanding more and more transparency of what their firms are actually doing.
I think that's a very interesting future. And then it's going to be very interesting to see how these various parties work with each other. So this concludes our interview. Thank you so much, Professor Wermers, for taking the time to talk to us about your experience in the financial field, everything from, you know, ESG to the new partnership that you know that you've announced to focus on studying environmental, and then at the same time, you know, I think it'll be very, very interesting as the you know, as the future really becomes more data driven. I think COVID has given a lot of organizations a very big push that direction. So again, I really appreciate your time. And to learn more about Hydrus, visit www.hydrus.ai. And to learn more about the University of Maryland, I believe it is rhsmith.umd.edu. Thank you very much.
You're very welcome, George, and I'm happy to speak for Hydrus, which I think has a very great goal, and is a very needed company out there. Happy to appear anytime for you.
Thank you.